Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, December 4th, and we'll see how things look for Friday, December 5th. Thursday was another quiet, range-bound session. The S&P 500 closed up just 0.11% on below-average volume after opening with early strength. The S&P briefly dipped into the red and then grinded sideways for most of the session. Breadth was decent but lacked conviction. The standout story on Thursday continues to be small caps. The Russell 2000 and its primary ETF, the IWM, etched new all-time highs. That's a meaningful development and a reminder that rotation into smaller companies still remains intact, although we have seen many fake-outs. This is especially important as the market prices in a near-certain Fed rate cut next week. Megacap tech was mixed and largely canceled itself out. Growth continues to lag value on a shorter-term basis, underscoring the defensive tilt that we've been seeing over the last few months. As far as interest rates, the 10-year yield ticked up to 4.11%, but the move was largely ignored by stocks. Geopolitical headlines and miscellaneous noise also failed to leave a mark. The market is in wait-and-see mode for Friday's session. Technically, the S&P is positive across all three timeframes, but the intermediate-term trend remains absent, and any short-term uptrend is still fragile. Overhead gamma resistance sits at the 6860 to 6870 zone for the S&P 500. There are a couple of signals to keep on the radar. There's a confirmed Hindenburg-Ullman, which is negative, and there's an unconfirmed Zwag NYSE Brett thrust that the market is still waiting to see if it will be confirmed in Friday's session. Market breadth, momentum, the smart money indicators, and sentiment indicators continue to improve or hold firm. Thursday's economic calendar delivered one clear standout. Weekly initial jobless claims plunged to 191,000, well below the 220,000 expected and a sharp drop from the previous week of 218,000. Continuing claims stayed comfortably below the psychologically important 2 million mark at 1.939 million. In short, the labor market remains exceptionally strong, according to this measure. Factory orders and the trade balance were both in line or slightly softer than expected, but neither moved the markets. All eyes are now turning to Friday's session, and specifically the core PCE, the Federal Reserve's preferred inflation gauge. Alongside that, we'll get personal income and spending, consumer sentiment, and consumer credit. Current prices currently reflect a 95% chance that the Fed will cut rates next week by 25 basis points. Small caps in particular are cheering the prospect of easier financial conditions. A hotter than expected or inline core PCE could trim those odds and pressure risk assets. A cooler number could potentially reinforce the rate cut narrative and likely ignite upside follow-through. In the broader context, we remain in a no-trend, choppy phase, but the internals are staying healthy. December seasonality is among the strongest of the year, especially in the second half of the month. Another seasonal measure is that during the first year of a presidential cycle, going back to 1985, the S&P has been positive 90% of the time, with an average gain of 1.9%. In this low-conviction environment, market-neutral option strategies continue to harvest theta decay quite effectively. In conclusion, heading into Friday, bias remains positive on all time frames, momentum is mixed to improving, and the tape is desperately awaiting a catalyst. Friday's core PCE will almost certainly provide it, unless it gives a mixed picture, either breaking the market out to the upside on a dovish surprise or keeping us range-bound if the data comes in as expected or slightly hotter than expected. Thank you very much, and I will talk to you in the next podcast.